You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options House, a powerful, easy-to-use, and intuitive online trading platform that's not only fast and reliable, but comes with dedicated customer service and a great trading experience. Trade on the platform that's top-rated by Barron's and Stockbrokers.com. With completely transparent, value-oriented pricing, Options House is your all-in-one solution for options, futures, and stock trading. Plus, open and fund a new account at optionshouse.com/insider today and trade commission-free for 60 days. Options House is a member of FINRA, SIPC, and NFA. And now, get ready to hit the option block.
And welcome to the Option Block for today, September 15th. We are midway through September, an exciting day today in the markets, as the last few days have been, by all means. We've been up, we've been down, we've been sideways. We have been all over the place in this market lately. And there is plenty to talk about today. But before we do that, my name is Mike Tussaw. I am not Mark Longo. I am guest hosting the show for today as Mark is on assignment. And with that, we do have our usual cast of characters, as Mark would say. We will start with, well, he always starts from that place in Maine, so we're not going to start in Maine today. We're going to stay local with Chicago, by gosh. You know what? Chicago's a great place. The Cubs are about to clinch the division. It's excitement in Chicago as well. So I'd like to introduce Mr. Steve Clausen from the Option House. Steve, how do you do today?
Thank you so much. I'm very, very happy to be here. There's this short window of time where the weather in Chicago is absolutely perfect. And we are in that 24-hour period right now. I don't know if you've been outside at all today, you guys, but it is literally perfect out, which, you know, the market up, Chicago weather great, Cubs about to clinch, as you said. And lucky for me, I am not a Bears fan. I am a diehard Packers fan. So football season starting, it's all good. It is all good.
Absolutely, absolutely. And you know, a lot of our listeners know my history, how the Bears so rejected me when I was a younger man. So I'm a fan of two teams, the Buffalo Bills and whoever plays the Bears. So I'm pretty excited myself about the Bears results the last week. But yeah, I agree. This is great weather, and this is why you live in the Midwest, is for weather like this in the middle of football season. It is just wonderful. But with that, there is a paradise out there on the East Coast that we know of as Maine. And how is the Rock Lobster doing today, Mr. Andrew?
The Rock Lobster is doing very well. I remember when I went out for a market maker training class from San Francisco, and I actually went out during this time of the year when the weather was perfect for the week that I was there. Like perfect. And I'm like, and I thought to myself, why is everybody complaining about the weather in Chicago in the summertime? It's great. And then I realized that yes, you get one good week of weather in the fall and one good week of weather in the spring, and everything else stinks. But you did have Michael Jordan, so that kind of helps balance the equation a little bit. But other than that, but now I guess you have the Bears, so that kind of cancels everything out.
Well, you know what they say about Chicago. It's the home of the this is a trading town. It's the home of the Bulls and the Bears, and I am not talking about the sports teams.
It's a fine town. I love visiting it, and I had a lovely time while I was there.
That is where those sports teams' names came from, right? The fact that Chicago is such a trading hub.
I'm sure it is.
Except for the Blackhawks. I don't know. Maybe I guess when they were trading, 250 years ago, when the settlers were trading with the Hawks or something like that, as furs for trade goods or something. But
we have other things to talk about in the trading universe rather than the names of the sports teams in the trading capital of the world, Chicago, Illinois, right?
We do. And with that, Steve, what are you seeing in this market today? I mean, we have the Bulls do appear to be in control today. What are you guys seeing over there?
So, what I think is interesting is, a week ago today, historical volatility was low single digits, right, in the S&P 500. And all of a sudden we've had 3 out of the last 4 days of larger moves in the market, right? Down big on Friday, surprisingly up big on Monday. I mean, that was a bigger surprise to me than Friday's down move, quite frankly. And then down again, gave it all back on Tuesday right away. Wednesday was an off day, and today was pretty powerful day. What's interesting to me is I think the strength in technology. Now, Apple gets the headlines, of course, and being at Options House, we get a lot of retail investors that are very interested in Apple, very interested in everything Apple does. The 7 seems to be sold out. A lot of times that's considered a bad thing, but that they can't keep up with demand. But it seems like Apple's gung-ho, but the technology strength today is much broader than just Apple and much broader than even Apple's suppliers. I'm seeing a lot of interest in keeping risk on, staying involved in the marketplace in technology names, while at the same time you see other sectors like some economically cyclical sensitive names in the industrials a little bit weaker, right? So that to me, that's telling me that people want to stay involved in the market. They're a little bit concerned about, rates up, rates not up, rates doesn't matter. They're a little concerned about the economy. They want to stay invested, and they're picking their sectors. They're picking the sectors that they think are relatively positively inclined. Biotech's another sector that's shown strength today and these past several trading sessions. I think it's really interesting that it perhaps is going to become a sector picker or a stock picker's market once again, and not necessarily, even though we're having these bigger moves, not necessarily a macro directional flush higher or lower for that matter. Up and down is really, we're still kind of in the same place we were, even though we've had some daily moves finally that we hadn't seen in all of, not surprisingly, we hadn't seen in all of August.
Oh, I see where you're coming from on that. And you're right. Apple is getting a lot of the headlines, being up, close to 15% over the course of the last couple of weeks. Andrew, what are your thoughts on today's marketplace? Looks like we had a little bit of a downturn in the VIX, to say the least, almost 11%. Just looking at this, for those of you that are not listening live, the VIX is at 1618 on the close today, down $1.96.
The range this week has been, I think, 12. What was it? Or a 1 week range has been 12 to 20. So, or close to it. So that's a pretty that is a pretty healthy range for a market that's gone what is it down, like 2.5% or something like that, 3%. We've had a pretty big range in VIX, and I mean the market's moved. We did have a couple of days of movement, but it's really not doing that much. I think as far as VIX futures go, or we were just actually looking at it in our chat room, and what I found what was kind of interesting is next week's weekly future, that the September 28th future, is actually, I know it's not traded super actively, but there's still price is still a signal, and that future is actually trading 30 cents less than the future expiring on the 21st. So there is, and I'm always looking for whatever indicator I could find, but that little tiny bit of backwardation, it's not a lot, but it's a little, is just enough to say, well, the market is not looking for a whole lot happening. Again, it's a small signal, but it's not looking for a lot happening after the Fed. I think one of the we have had a little option pit mantra over the last several weeks. I think 2 months almost is all the volatility is coming from the Fed. At least the environment we're in. The Fed governor says something spikes. So from a vol point of view, the vol event is the 21st. After that, are we back to 13 VIX? Probably. We could be to a 14 on Wednesday after whatever the FOMC meeting says. So I'm looking at that. The second part of the equation, I think like Steve said, is the technology. I've kind of been on this year is like the Qs. I think were a very save for Amazon, maybe the big Q stocks like Apple, Microsoft, Google, Intel, the big chunks of the market cap are not anywhere at the valuations. The stock prices are higher, but they're also, those companies are making tons more money than they were in 2000. It's 16 years later, and they're massively much bigger companies, but the stocks are in the same place. So I didn't think the Qs look very big. I think this driverless car thing, this drone thing, this technology thing that happens cyclically, it's a cyclical thing, but I think the semiconductor part is driving some demand and all that. So those are all, that's kind of really the engine that's been driving us for the last, because for sure it's not oil or financials right now because those have stalled totally. But yeah, and Apple is not a very expensive company if they keep selling phones. So, and everything else seems to be going with them. Something like Cisco, I know we don't mention it, but that is, I think it's very close to a multi-year high. Microsoft, same thing. So the only thing is, again, there is some rate fears. There are fears that they're going to stop doing all this QE, and that will take the market down at some point, for sure, because that's all the algos are tied to all those news, whatever the news feeds come out, and they blast away and the market falls apart. And then the next day happens and everybody goes outside and the sun is still shining and rates are really only going to move up a little bit. And, was it really worth the government doing all this in the first place? I think we've argued on the show that probably it hasn't really bought the kind of return that they wanted. And now we go back to an equity market near all-time highs. And while the valuations on some things are, let's say, higher, I think the Qs, for an example, again, take out a couple stocks like, let's say, Netflix or Amazon. Those have some market cap, but they're nothing compared to the top, out of the top 10. All of those valuations are, are fairly reasonable. Or so that's what we've got. So if the Fed is vol and the Fed's not saying anything, vol's coming in. They have a vol event on the 21st where they're going to say something, and then vol will go down, and the stocks will probably be back to that listless doing nothing until the Fed actually gets themselves out of the market by saying, this will be our rate hike, this is what we're going to do, and we're not going to talk anymore until then. Play on. And but let's see if we actually see that.
No, I would agree, and I'll be honest with you. I really don't see how the Fed. I really don't see the Fed raising rates this year with all the circumstances that are going on. I really don't think that Janet Yellen wants to be the Fed governor that made the market go down. We do have an election year, and that seems to be, even though the Fed is not a political organization, it's totally independent. I'm sure we all believe that, right? So I have a hard time believing that the Fed is going to raise rates this year. Now, if it could happen, yes, but I really don't see it happening at this point. They might try and sneak one in later in the year, but I really think that's even doubtful. Steve, do you have any thoughts on that?
Just comically, I tend to agree with you. I don't think there's going to be anything next week. I think the market's pretty much telling us that one's off the table. Financials, with they pulled back. They obviously benefit from a rate increase. If don't want to get into politics, but if Trump manages to win in November, I could see Janet Yellen as a little parting shot, doing something in December and doing something bigger in December as she like closes her office down. But you're right. I mean, the Fed, if in a vacuum, if they look at this global, if they look at our economy, which is tied to the global economy, there's really no hurry to try to raise rates unless there's some back office dealing where the Fed says, listen, we're going to raise rates in the U.S. so that will allow you, Fed governors and central banks around the world, to get your rates at least back to zero. And I oftentimes think that they don't know what that world really, what the impact of that kind of negative rate environment world is going to have, other than safe sales in Germany exploding through the moon, and because people are looking for bigger and safer mattresses to stuff their cash in. The only reason I can see the U.S. raising rates is so that it gives the rest of the world some room to be able to not be negative. And that's just my own thoughts. I haven't read anything from anyone that has, some intelligence on this about that, but you just can't see anything in the economies around the world and our economy too, quite frankly, that indicates that a rate increase is needed.
No, I would see that. I mean, it's not like we have a burning hot economy to where we just need to slow things down. All right, well, that will conclude the trading block for today. So let's go ahead and transition into the next segment of our show, which we all know and love at this point, and that is the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the second section of our show today, the Odd Block. This is the section of our show where we look at unusual activity and things that look just maybe a little bit, how do we put it, odd. The first stock that is coming to the Odd Block for today is Lending Club, ticker symbol LC. It's up 43 cents on the day to 618. It is near the bottom of a 52-week range. Paper traded 5,000 of the October-January 6-8 call spreads for 20 cents. Average daily volume on this one is 8,500 contracts, and the open interest is 7,500 and 35,507 respectively of each option. Volume did go up in 2 blocks on the ISE, a marked spread. This roll could be a close on the Octobers and a move to January's for a much higher price. So maybe the trader wanted to roll up and out his covered call, but he may have been doing some other things. Andrew, what are some of your thoughts on this?
My thoughts actually are, what happened to Lending Club this year? Did they get called out on this whole thing? That stock has gotten totally annihilated. Anyway, what I thought is it looks like they were all along some odd calls. They get a little bit of a bounce, and they're actually buying the Jan 8s the way it was priced. And there is massive open interest on the 8s. I think the stock was like 12 or 14 bucks or something this year, as I recall.
Yeah, that's right. It was a significantly amount higher, and then all of a sudden there were all sorts of little whispers of irregularity, which just annihilated the stock back in late May, I think, or mid-May.
Yeah,
of which now it's trying to recover. I mean, it was looking like it was dead, but then today they announced that they had, excess capital and things like that, which helped the stock 7.5%.
Yeah, so I'm looking. Maybe it's all the stocks with L's. There was lumber liquidators that didn't do so good. Now we got Lending Club. So
Lululemon.
Lululemon. So I could see that, you have got your OX6 calls. They might have scooped them for nothing, and they want to roll them up, or they're trying to create a diagonal for a little bit of a credit, which could work. Because these 8-level calls in January, I have to say, they're not very expensive. I mean, the stuff is, the Jan 8s net were like, 30 cents or something like that? Yeah, they're 35 cents. So, I mean, a reasonable, tiny little call on a stock like this with some potentially good leverage. I mean, a stock could go back to $8 or $9, and somebody could be sitting on a triple or a quadruple or something like that. So, I think reasonable. I think it was kind of rolling for dollars. They took their OX6 money and they went to the Jan 8 money. So, or it would be a very, I would say, aggressive diagonal spread, selling the 6s and buying the 8s if they were both opening, because you would be pretty short. So if Lending Club actually kind of bounced or kept going up, it would be an ouchie. That trade would not make you very much. You would lose money on that, on the spread. So,
right.
Thinking it's
Oh, go ahead, Steve. Sorry.
I'm sorry. Don't mean to jump on top of you, but I don't think it's a opening trade on both sides. It just doesn't feel that way to me. We'll be able to tell, of course, when we look at open interest in October tomorrow. There's 7,900 today, and 5,000 of these things went up. So we'll see if that open interest. I mean, if it stays the same, it could potentially be closing on one side, and the seller may be opening, and that tells me that the October leg is closing. If it goes down, then it's closing on both sides, which would be highly coincidental. And if it goes higher, then that means that it was in fact a opening trade on both sides of the leg. The interesting thing to me is these Jan 17 8 calls, 35,000 open interest already today. So that is the option in this trade. And you look at it, and it is far out of the money, but with the volatility where it is on this stock, it is a 25 to 30 delta option, which is the prototypical covered call option. So I think more likely someone, when the stock was at 4, said, oh my goodness, I got to sell some upside calls, which were 6 at the time. Stock has rallied back to 6. Now those are at the money, and he's paying 20 cents to roll them from being at the money to being out of the money again, back up to a 25, 28 delta option in January. And paying, up $2 and paying 20 cents, he probably thinks that might be, a step up and step out. Try to get that stock back up to double digits.
Yeah, the classic up and out roll for sure. All right, next stock that we have on the list, BLOX. Infoblox, I should say, ticker symbol BLOX. It's up 32 cents on the day to $22.95. It is near the top of a 52-week range. Paper traded, 120 blocks, October 25 calls for 40 cents. Typical ADV on this is 576 per day. And the open interest is a whopping 10 contracts. Volume went up in one block on the CBOE. There was scattered buying on several floors that took to over 1,000 contracts in a thinly traded name. Buying does look to be bullish, as prices did go from 31 to 40 cents. Andrew, what are some of your thoughts? Or actually, I will give Steve, what are your thoughts on this? We'll let you go first. And that guy from Maine that's making fun of our hometown. We'll let you go first today, Steve, on this one.
So these stocks that don't exhibit a lot of liquidity, it's amazing to me that liquidity, or the desire for liquidity, can find a seller. Yeah, we think this was, the initiating order was on the buy side, but this stock, open interest 10. If you look at all the open interest up and down the chain, there's one strike typically in any month that has, significant open interest. And yet the market's being, this is more a testament to the market's liquidity and the market's availability for liquidity when demanded or when requested is actually a pretty cool mechanism, right? This to look at this stock and say, hey, I'm going to be able to put up almost 2,000 options and get them with, it did move the price up a little bit, but that's what markets do. They find an interested buyer and they attract interested sellers to provide the liquidity. And it's kind of cool that this trade in this size in this little name was able to actually even happen. It just tells me that the market structure and the market mechanism that's out there, especially in the options market, especially at the electronic age in which we live in, is actually pretty healthy. Now, as far as this specific trade, again, buying out of the money options, and we do think this was a buyer on the initiated side. Obviously we'll keep an eye on this name as time goes by between now and October. It's in the next month. They definitely are looking for a move in this stock. It's up 2.25% today, 50 cents. Get 4 more of those days and you're right there.
And it seems like probably every 8 or 9 in the 5 or so years that we've done this show, about maybe every 7 or 8 months when we do something like this and someone's just buying a ton of out of the money calls, and then all of a sudden the stock's up or it gets taken over the next day, and then the stock's up 40% the next day because of some type of news of something like that. And we found that several times on this show. Not sure if that's going to happen with BLOX, but you never know. But Andrew, what are some of your thoughts on this?
It's a stock that was $14.50 in May, and now it's 23. So somebody likes it. That's kind of a big move.
It could be.
It smells a little takeover-y to me as a kind of a potential target. It doesn't mean it's going to, but it has all the look and the sound. The market cap's not very big. It's only about a little over $1 billion. The company makes money. Somebody is definitely trying to, they're trying to ride the wave higher for sure. And I'm not sure because the nature of the volume was all kind of, it was a lot of scattery paper. It wasn't big blocks. It was a little block here, a little block there, some on that exchange, some on this exchange. Could have been some sort of newsletter trade. It was just hard to get the volume up, and it took a little bit, but they did trade. Like Steve said, they all filled. So again, it's a thin name, and somebody wants some out of the money calls. Probably worth watching as some kind of potential flimflammery or skullduggery or something like that, as somebody's trying to pile into some of these calls a little early. So, but it's been moving huge. It's up 60% in 4 months. So that's something.
Yeah, that's true, and these are always my favorite ones to watch on the odd block because you're right, it could lead to, as you put it, this is a technical term, folks, flimflammery and skullduggery. So if we can see some of that, we'll definitely have to put this one on the list to keep an eye on, because if this one's all of a sudden at $38 one day in the next, by October expiration, definitely a head scratcher. And with that, the next name on our list has to do with actually kind of what Steve was talking about at the top of the show, and that's the technology sector. Ticker symbol XLK, the ETF that tracks the technology sector. Shares of it were up 66 cents on the day to $47.47 on the day, and it is near the top of its yearly range. Paper traded over 11,000 contracts on the October 28th. I'm sorry, the October 28th calls, I believe this is. The October 28th expiration, 47.5 calls for 80 cents. With this, the ADV is just under 11,000. Open interest is 17,500. Volume did go up in one big block. And so with this, someone, Steve, did you make this trade? You're bullish on technology. Are you loading up on those end of October calls?
Yeah, that was me on the 11,000. I don't know who did the 200 extra contracts. No, absolutely. This was not me. But you know what's interesting is the actual expiration date is the 28th, right? So this could be someone who says, yeah, technology's been a strong sector. Money's rotating into that, maybe out of financials, out of industrials for the time being. And what do you get if you get all the month of October? You get a lot of the earnings that are big drivers in this XLK ETF, right? You get, which now when you're buying these sector ETFs, it really is a focused bet on one industry, right? Granted, a large industry, and technology is a large sector, so the volatility of that would be less perhaps than the volatility of buying a basket of 10 different technology names that you like. And the advantage of using the XLK, if you're bullish on technology, is you're not picking necessarily the winners or the losers. You're picking the group that you think will outperform, and more large portfolio managers are managing their books, by sector rather than by specific stocks. And I see this as, potentially just the manifestation of that. XLK is near the top of the 52-week range, like you mentioned, and, no stock has ever made a new high without being near the top of the old high.
Very good point.
Andrew, like that one.
Now that kind of
I think I actually learned that from you guys,
Well, I think that would always that's the counterpart to my classic. Never been a better time in the history of the market to sell than right now. So that's the flip side of it. I do like that. That's good. Andrew, take us home with XLK.
And I saw a paper buying these calls yesterday as well. I was trying to see if somebody just tried to scalp them, but they would have only made like a nickel or something. So I don't think that was it. Still trading on the offer. They're also buying the OC49 calls in the regular OC cycle and the serial cycle. Just a lot of dang call buying in XLK. So again, I didn't see any stock blocks going up against it. When they print on price variation, sometimes there's stock against it. I didn't see anything near this size, 11,000 calls. I didn't see, like 400,000 share blocks going up. So they're either hedging a short position that's not working very well right now, or they're putting one on, or they're riding the Apple, Google, Microsoft, Intel train higher, which right now, it doesn't look so bad. I guess maybe on Tuesday it didn't look so good, and Friday of last week, but today it looks okay, and the buyers are stepping back in as long as those nasty rate fears stay away from people. But it just could have been a buying opportunity, early in the fall or late in the summer, however you want to think about it.
Yeah, I would kind of lean toward that as well. And like you said, it might be if someone is hedging a short position that's not going well, that would really be kind of a rough spot to be in right now with volatility higher and Apple and Google doing, or the train, so to speak, running things higher. So hopefully for their benefit, they're just riding things higher. And that concludes the odd block for today. The next section of our show is our favorite. That would be the mail block.
It's time to take your seat on the all-star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
And welcome to the mail block. This is where you guys get a chance to ask us questions and see what we think about various things. And I always like this section of the show because it's always good to hear what our very loyal audience of over 550 episodes and many thousands of people has to say. The first one that we have is from Yukoner. Interesting name. Do you ever do spreads in leaps? Why and how? So I used to trade the leaps rather than buy the stock. Is that a good use case? Andrew, I'll give you pride of place on this one since we've been going with Steve the last few times.
Well, let's see. Are leaps a good replacement, or are they good for spreads? Let's just say it depends. What I would say is sometimes leaps are good things to own, and then you could write things against them. I think that kind of makes sense. What I would tell somebody is if you're using time spreads with leaps, they are almost like two different products. And the reason why I say that is because the distance between terms are so far apart, the character of how the options trade short term versus a leap is really different. So there's a lot of gamma in the short term stuff. So those options tend to move around a lot when the stock moves. And the leaps don't move as much. So if you use a leap instead of stock, that's probably a better proxy for it because they move. They're volatility sensitive for sure. I mean, they're extremely vol sensitive. When the market moves a lot, the vol will move a lot in the leaps. But as far as from like time spread point of view, it's a little trickier to time spread because you want the leap to kind of move with the option you might sell against it. So you have to be careful with it there. So, you know, if I'm buying a leap, I'm not doing a long-term time spread, meaning like a vertical spread. What I'm more looking for is, okay, I kind of own a leaps because they're cheap, and then you get a little pop or something like that when it's interesting, and then you sell something forward against it when you have already kind of a move and you have a little value built into the leap. So as a stock replacement, good. You don't get the divvy, but it's also costing you a lot less for the position because generally, you know, the cost of the leaps is a lot less than just going out and buying the stock.
Yeah, I think that, and just to kind of add to that, one thing that I always tell people is that a long-term option gives you long-term movement. So, for example, if you're using a longer-term put option to protect your stock, you're going to get long-term protection, meaning right away, if the stock were to go down, the put option isn't going to move as much. It's designed to be longer-term protection. The same as if you're just, let's say, to keep things simple, you're just buying a call option, a call leap. You're going to get long-term upside movement. It's not going to move that quickly. So I think you just kind of have to figure out what works best with what you're trying to do. Steve, any thoughts on this?
Yeah, I like how Yukoner left it open-ended, right? Do you ever do spreads in leaps, right? So it could be any type of spread. So answering his second question first, as Andrew pointed out, leaps as a stock replacement use case. Yeah, we see really success. Well, there's upside and downside to every trade, but we see a lot of derivative traders using leaps as a proxy for long stock, and then they would, like they would do with long stocks, they'd want to create some income and sell some shorter out of the money options against it, big fat diagonal, and then keep rolling those shorter term options as they become close to being in the money or tend to expire towards, worthlessness. Is that a word?
I think so.
but actually what you talk about is long-term movement and long-term protection. And that's a really good point. Leaps, they don't have gamma per se. They don't decay a lot. That's the positive, that they don't decay a lot. They don't have gamma, so they won't accelerate in exposure. If it's a 60 delta leap option, when you put it on, it's going to be a 60 delta leap option for quite a wide range of prices and for quite some time. So in that regard, yeah, you have 60% of the risk of stock, and so you can plan accordingly. And if you sell a close to the money option against it in the shorter term, that option could very quickly, and that whole spread, that whole position could very quickly turn into a negative delta exposure spread, which might not have been your desire. So you'd need to definitely stay on top of that. One thing that we haven't talked about, and I'd like your opinions about too, is occasionally I see people do really wide vertical spreads in the leap itself, in the same expiry, January of 2018. Someone that's bullish on, some high flying stock, Amazon, Google, whatever, where they buy a 50-point leap vertical spread, January 18 to January 2018, right? They're in the same month. And it is a very slow moving trade, right? They do that oftentimes to diminish the impact of implied volatility moves, because since they are long an option out in time and short an option out in the same amount of time, that diminishes the vega risk associated with owning leaps by themselves. They typically have very small decay, but oftentimes they put these on at a point where they are actually theta positive, meaning as time goes by, so slowly, that position does decay. They can put them on oftentimes for less than the current parity amount from the owned lower strike call option, for instance, to, they buy them for less than the parity amount of the option of the lower strike option that's in the money. And they think that it's just a very slow, steady income generator. Have you guys ever thought about that? Or I know you do a lot of strategy blocks and strategy teachings. Do you ever get folks that are saying, hey, tell me about how I can do verticals long dated, and how can I value those things?
It is funny you mentioned that, Steve, because in the strategy block here in about 5-10 minutes or so, was literally going to talk about my vertical leap roll that I did last week. So I'm going to save mine for then.
Yeah, okay.
But Andrew, do you have anything on this?
As far as like long-term verticals, maybe when the vol gets a little nutty, it helps. I think if volatility gets super expensive and you kind of want to get long at the bottom, I think like times or vertical spreads make a little more sense because you're not taking that massive penalty for paying big long-term vol numbers, which could work. So that's about the only time I think about it working there, but there could always be other times I'm willing to hear.
It's the tease. It's on. Mine's more has to do with hedging though, but I'll still save it for the strategy block. But definitely some thoughts on it. So next question from Trader Shawn. What is the difference between USO and UCO? Steve, you want to take that one?
You know what? I can. USO. The problem with USO is it has a negative drift because it uses futures to get crude, and UCO isn't that 2 times levered or something?
Do you guys ever work with that one, Andrew?
No, mostly USO to me is just a kind of one of those craptastic products. So it's sort of like put ratios and stuff like that, where you just kind of, it doesn't seem to do. Unless, obviously when the market was moving a lot. UCO we don't touch very much because I think there's just too much internal drift in the product to make it really worthwhile. So it's only a product I would use at an extreme, meaning, you're looking for something to happen relatively fast and you want the leverage to make it work. I'm trying to remember the last time I actually put on a UCO position. I can't remember. I don't like those leverage products for the most part, unless it's literally for like a super short-term trade, because there's just, like just Steve said, there's too much drift in UCO, and USO, it just has the contango problem. So I think they're like anything, they're very specific types of ways to trade oil, and I think you have to use the way the product's designed to best take advantage of that.
Got it. No, I think that makes a lot of sense. And a lot of those products, the way that I view them is if you really want to trade that type of thing, and you really want movement on oil, then this is kind of my solution to it, trade oil. So I guess maybe I'm kind of a simple man, but just open up a futures account and do it that way. So, or go to a place to where maybe you can do futures and options in the same account.
That would be us.
I
Put us in, Coach.
I was going to ask if such a thing existed at the auction house. Funny you should mention that.
Yeah, absolutely. We've had huge amounts of interest in our futures offering, especially because you can do it from the same sort of capital base, even though it is a unique account because futures are CFTC regulated and securities account is SEC regulated. However, we make it really easy for folks, and there's a lot of people that say, hey, wow, I own ExxonMobil, and every time oil's up, I'm doing great, and every time oil's down, I'm doing horrible, and I'd love to hedge that, and using USO, too many moving parts, but the crude oil futures can be a relatively liquid product. A lot of people are expanding their asset of their universe of assets that they're trading, and we're seeing a lot of people that are using futures to hedge, to speculate on some things outside of the normal assets that they trade in a regular securities account.
Yeah, I think, and that's just a wonderful service that you guys have, and I think it's a great thing for the retail trader. I think that I can't say enough about how handy that can come in if you are a retail trader, and just the scenario that you mentioned with the Exxon and oil, the convenience of that. Folks, check it out by all means. Final question from Vegs. I'm seeing a lot of big fat options open interest tied to the big ES 2200 strike. Does this mean big traders are betting that the S&P will rally past 2200? Can all of this open interest have a net effect on forcing the S&P to that strike at expiration? Do you view this open interest solely coming from the pros, or are retail reflected there as well? Well, first off, I believe the abbreviation for the big futures contract is SP, not ES. Am I right on that? I always trade ES myself, but anyway, with that, Andrew, you want to take this one?
Yeah, we thought, at least, Mark and I did a while ago, when it looked like, oh, yeah, where the rally in the summer is going to continue, and they're going out to the 220s, and it's going to be super awesome, and no.
It just stopped right before it.
It just hit a wall of, for lack of a better term, doo-doo. There was just there's no more Fed, there's no more ECB, there's no more monetary easing. We don't know who the president is going to be. We don't have any economic policy that's jacking people up. Earnings aren't around. I mean, come up with a reason to rally more, except for the fact that, you can borrow money for nothing. So that we just ran out of reasons to rally. And I think, yes, could there be some kind of little squeezy action at that level? Certainly possible. They don't have to worry about it when you're not.
They expire tomorrow. They expire tomorrow morning.
So we'll just say I normally don't make a pronouncement like this, but I'm feeling that they're going to be okay on those 2200s, the 220s. 230,000 of them are going to go the way of the dodo.
The dodo.
And you know what that is. That is dead, dead, dead. I guess we could rally 2.5% tomorrow. I'm not seeing it, because that means they would crush volatility, and my little vol positions make me tons of money. So I'm probably guessing it ain't happening tomorrow. Probably. It ain't happening tomorrow. Next week we could see something, but I don't think we're going to get it tomorrow.
Got it. All right. Well, on that note, that concludes the mail block for today. And we do have a little bit of extra time today, so let's go into the special Thursday edition strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
And welcome to the strategy block, where Mark Longo's birdies, minions, and his entire staff of various animals and fictional cartoon characters, they went with him to his conference that he's attending this week. So we're just going to kind of do this live and on the spot without any indication from what the birds are talking about, with the exception of the hint that I gave you about 5 minutes ago. What we do at RCM, we have a portfolio that we refer to as the hedged strategic night. And that is where we use a basket full of stocks picked by our investor policy committee, Chris, George, and Tim. Their job is to pick the stocks, and my job is to hedge the portfolio. And so the hedge with which we came up with on December 31st, going into this year, was that we were SPY. We're using all options on SPY, so that way we don't have to write individual covered calls and do puts on all these individual stocks. But the hedge with which we came up with was we were going to use the January 2017 205 185 long put spread. SPY was roughly 205 when we put this on. And to finance it, we were going to use we did use the 225 245 call spread, shorting the call spread. So what we did was, this is all vertical. It was all roughly 13 months out. And it ties right into the question that we got today on doing long-term verticals. Now, why did we do this? Well, a couple of reasons. First reason was that we wanted to have protection to the downside. Now, granted, we did not have doomsday protection, meaning if the S&P went to zero, we would not have that. But we did have protection for the first 10% drop, assuming we used it and held it until expiration. If the SPY were to go down to 185, and just for sake of this example, we do have it marked out with how much the portfolio of stocks matches the S&P, and it's fair. We're trying to keep it fairly close, but I can get into that another day if anyone's interested in discussing this. But let's just assume that this is hedging the S&P for sake of this example. So we have protection against a 10% market drop, and if that were to happen, then so long as SPY stays above 185, then we have full protection in place. And the plan was, if SPY were to go below 185, we would roll it down. We actually were using 180 as our mark, to where we would roll down the short put from the 185 put down to the 165 put, and so on down the line. Luckily we did not have to roll down the 185 put, but my finger was on the button one day when we had those crazy markets back in January, I have to admit. Now with that, when we did have some crazy market times in January, we were able to close out the short call spread for a profit. It was worth, I think we originally got a credit of roughly $3.45 for it, and we got out of it for 70 cents when the market dropped as much as it did. So with that, we were able to finance a pretty decent portion of that put spread. I think it came out to an overall cost to the portfolio of roughly, it was less than 2% of the overall portfolio, and we were able to have this hedge in place. Now, to the upside, we had all the upside. We had room for 10% approximately of upside in the market, but the second 10%, between 225 and 245, we would have lost money on the call spread. Now, SPY has never gone to 225, but we were willing to give up between 10 and 20% as the upside. But if we were to have a 40% up year, we would have been able to have all of the upside past 245 in SPY. So that's how we kind of came up with that hedge. Now, markets came up again, and then in July, we ended up selling that 225, 245 call spread again for $3. And then markets just have kind of puttered around a little bit since then. And then just last week on September 9th, we actually closed out everything. And so by closing out every hedge, what we did was the markets are up roughly near 5% on the year. And so the strategic night, if you want information on what that's up and that's down, feel free to call and we can talk about that. But the point is that with this hedge that we had in place, by having a long-term focus, it cost us literally 8 pennies with all of this. And so the benefit of this, the reason that we were using long-term options was because we were looking for long-term protection. And so the long-term protection that we had, we were able to rest easy at night knowing that we had that in place for the longer term. And with the longer-term protection in there, we didn't have a lot of time decay on it. So with that, you look at the 205, 185 bear put spread. We're buying volatility at the 205 level, and then we're selling volatility at the 185 level. With the vol skew that exists, we were buying a lower vol option, selling a higher vol option like you would by buying any vertical put spread. Same holds true for the call spread, except it's opposite, in that we're selling a 225 call and buying a 245 call. With the way that the vol skew works, and it doesn't work like this every time, but the way that it does typically work on S&P products, we were selling a higher volatility and buying a lower volatility. So because all of this matched up, we locked it in for a longer period of time, and we just worked with market movement, and the market moved in our favor enough times to where we were able to just get out of the hedge for a cost of 8 cents over the course of 8 months. So we paid a penny a month for the hedge. And what we did recently is the new hedge that we have on, we were able to kind of ratchet it up. Same concept as before, except now we're using September of 2017, and we're doing the 215, 195 put spread. We were able to ratchet it up since instead of being at 205, it's at 215 now, and we're doing the 235, 255 call spread for a very similar price. So that's an example of how we have used longer-term verticals, and it worked out pretty well. This is the first time we've done this with this type of a hedge, but so far it's working. So we've done every hedge you can imagine in the past, but this is the first year that we've gone with 2 verticals to do this hedge. So that is the strategy block for today. And now we're going to shift into around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, Andrew, what are you guys watching going into tomorrow and next week? I know the Fed is definitely going to be on your radar next week, but what else?
It's pretty much just the Fed till they just stop ruining the stock market fun. Tomorrow, I don't expect a whole lot to happen. Probably get a little more weekend markdown. Vol gets a little lower again, and we'll just wait for some other dumb pronouncement. We'll see if this rally can continue, if Apple can keep rallying and rallying and rallying like there's life left. Like they ran out of iPhone 7s to sell. I don't know how they do it every time. They make 100 million of them and they always run out of them. So, but heck, that's why Apple's Apple. So we'll just see if all that continues and if there's really anything under anything under this bounce. So we'll see, but it looked kind of like the standard bounce back from Mayhem today, and we'll see if it holds up.
Got it. And I don't think Apple's Apple anymore, but that's another story. But anyway, Steve, what do you got on your radar for the rest of this week and next week?
Yeah, pretty much the same. I want to see if the market can find a direction. When it wasn't going anywhere at all in August, it didn't go anywhere at all. Now it's going really quickly, coming back really quickly, going really quickly, and it's still not going anywhere. So, we are in a range, right? And either some sort of bust out to the upside, a true bust out to the upside, which, those September 220 calls or 2200 calls are they will be dead and gone. But, it would take a move through that level in the market to the upside to prove something to bulls, and a move to the downside. What we've had is this is nothing given where we are now, right? We're up 4% on the year, kind of a year, but it'll be interesting to see if in fact volatility does come in after Wednesday's Fed day.
For sure. All right. Well, that concludes the show for today. Thank you for listening, folks. And before we sign off, Andrew, can you tell us what's going on in the option pit?
September 24th, we'll be talking about the new daily options. I think they're going to list these on all the products within a year, all the big trading products, the Mondays, Wednesdays, kind of the stuff that the off cycle, we'll just call them the off cycle daily expiration. So we'll be doing a webinar on that, trying to use these things, just understanding the pitfalls and the ways that these things actually move around to give because they're not, it's kind of like expiration every day. So there's a lot of explosive potential there. And that is our big thing. We're rolling out our gold class will be live for the next quarter for all people that are interested. And again, learning about, how to trade options, how to use volatility to trade options, how to use volatility to understand how options are working and what it all means. You will be able to pop in to Option Pit if you're a subscriber, a gold subscriber, and we'll be doing that live for the fall of 2016. So surf on over to optionpit.com and get all the information you need there.
Steve, what do we have going on over at the Option House besides futures and options in a very convenient setting?
In a very convenient setting. We, I would echo Andrew's comments just about the proliferation of expirations. And, SPY now has Wednesday expiration. Now, when SPX had Monday expiration, Wednesday expiration, Friday expiration, those are cash settled options. So those on expiration itself is just a settlement date, and it's a settlement term, and it's a the end of the life of the option, and you get cash for the difference between any in the money amount between your long option and the settlement value. However, with SPY and having Wednesday options, Wednesday expirations, those expire into stock, and so be very, very aware of what expiration cycle you are trading. Your option chain is going to show all of those different expirations, and it's really imperative that if you have an upcoming expiration, and if it's Wednesday, you got to know to be out of those positions. Otherwise, you might have a stock position you don't want to have. Next week, we are doing a webinar on call spreads, all things call spreads. So call verticals, as well as using leap options or cash secured. Stock replacement calls, and diagonally selling a shorter dated call and creating an income strategy using leverage and having to manage those and roll those, and all things call spreads being discussed Tuesday, September 20th. And I invite anybody that wants to come to that to come to that.
Sounds good. Well, on behalf of my partners in hosting, Steve and Andrew, I would like to thank everyone for listening today, and be sure to tune in next week as we are back on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.